Hey, good people, it is Saturday, March 6th. So happy Saturday, March 6th. Not sure what you got going on today, but if you don't got too much going on, check out the man John Carter's class. So I'm going to be trading live in the Small Account Secrets class on March 10th and 25th, but John is doing a class here this afternoon. Check it out. Interestingly for me, the small account class that John's been doing for a while now, this is before I joined Simpler. That really tied things together with me as far as, probabilities and growing an account, important concepts like reversion to the mean. So check it out, check it out. But woo, what a week for the market. So, we've got a lot to discuss. Let me move myself over there. We've got a lot to discuss. We've got a lot to get into. And then, I don't want to call it tough love. Maybe that is the right word for it, but I'm getting texts this week. I'm getting emails. I'm getting DMs. I'm probably got a couple letters coming in the mail. And this happens anytime the market pulls back a bit. Folks are just taking way too much significant pain. So we got a full list of things to talk about for this weekly review video. Let me take a sip of some caffeine. But gang, let's get jumping in. Obviously a volatile week for the market, and let's take a look here first at volatility. So simple stuff, and in these videos I always like to bring y'all back to the basics. Anytime you get the volatility index pumping as it is right now, you're going to see some downside in the market, and a really kind of simple mindset. God, I'm starting to annoy myself. A really simple mindset is that as long as VIX is above its 21 period moving average in the daily chart, it's a safe assumption that the market hasn't put in a bottom yet. So you do get here on Friday. We're trying to break that Bollinger Band, and you did get a nice flush. So this coming week is a new week. Who's to say VIX doesn't just start to rip once again? But if you take a look at the volatility index, typically what we get is a big, ugly push through that top Bollinger Band, but then that's about it. Right? Big, ugly push, and of course, the coronavirus, right? That's kind of like a black swan event. So more often than not, you get these little bursts of volatility. VIX is trading through that top Bollinger Band on the daily chart, and then things die back down. And it's a pretty easy roadmap to follow if you can be patient enough to wait for some confirmation. So we did see the big bounce into the close on Friday. You did get the big retracement here for volatility. Are we out of the woods just yet? And should you put your entire account into calls? Not necessarily. Be patient, wait for VIX to dive right back under the 21. And the interesting thing about the downside is it can happen so quick, it can be so nasty. It can also end pretty quick as well. So I'm not saying that's what's going to happen here, but as long as VIX is above the 21, good assumption that the pain isn't over yet. Let's take a look at the market. And let's start with the SPY here from a weekly perspective. Even with all the choppiness and the volatility this week, this is a good looking chart here, gang. Stack moving averages, green 10x bars. We didn't even test the weekly 21 really, and we closed above the 8 EMA. So a lot of the weakness this week was in the tech stocks and the semiconductors. The S&P 500, it holds up pretty damn good here because of all the rotation into the financials, which are just going crazy here. Energy's going cray-cray. The industrials. So in different sectors within the S&P 500, we're seeing enough strength with the rotation out of technology and others to hold the ship afloat. So the S&P 500 does look pretty solid here from a weekly perspective. On the daily, here's the thing. Until we're closing back above that daily 21, and until on the histogram, we can get rid of these red bars. Red bars on the histogram, bearish momentum. You ain't going to see the market going back towards new highs until we can see some yellow bars coming in. In the yellow bars is just simply the exhaustion. So with the index under the 21 and with a little bit of bearish momentum on the histogram, this is what you got to be careful of, and you got to pick your spots wisely. We're going to kind of see the same ebbs and flows of the market that we see when we're trending to the upside when we're potentially trending to the downside. And all that really is, let's get the Keltners. All we gonna do typically is push 2 or so ATRs to the downside and then quickly revert back to the 21. If we don't close above the 21 and you still got bearish momentum, typically we're heading on back down. And that's kind of the rhythm. Big push away from the 21, quick rally back to it until the day comes when the sky's clear, you close in back above the 21, and visually, this is what you're looking for from the histogram. Bearish momentum drags the market lower, the exhaustion of the bearish momentum, we holding up all right, and then some fresh baby blue bullish momentum, we're back to business. So, we find ourselves Thursday, Friday, 2 ATRs to the downside, in my opinion, not the best spot in the world to get short, because you're getting short just as you got this growing probability, you're going to do exactly what we did there on Friday and rip back towards the 21. So we didn't quite close above it, so Monday's session should be interesting. If we close back above on Monday, maybe we've seen the end of it. As long as we're under the 21, you got to be careful of any rip towards the moving average getting stuffed and rejected for another leg to the downside. So all in all, S&P 500 looks pretty good. Technology was getting slap silly here this week. So weekly perspective, and this is just, I love this kind of stuff. This is interesting. This is going to be an interesting chart to come back to April, May, as we see how things unfold. But I've been of the mindset all week here that potentially what we're seeing is a very strong market on a weekly chart, giving us a nice healthy pullback to the 21 before all that selling pressure softens up and we make another trip back to the upside. So I'm sitting here on my hands saying, hey, this is either, come April, come May, we're going to be looking back at this chart saying, ooh, that was one of the best dip opportunities of the year, or we're seeing a complete shift of momentum here for technology, potentially, call it a short-term little downtrend. So you did get a little bit of a flush under that weekly 21 on Friday, but with the big pump, we did close above it. So next week shall be interesting. Under the weekly 21, there's certainly some more room for downside. So this is a big kind of line in the sand here that we want to see technology hold. So the weekly chart, before we get off that topic, it still looks pretty solid here. Just my opinion. Not calling for a bounce here. I'm not saying this is the bottom, but good looking weekly trend, reversion to the mean, stacked moving averages. Solid stuff there. From the daily perspective, I would have not wanted to have gone into the weekend here short a bunch of technology stocks. Reason being is that you already got the big push. 2 or so ATR to the downside, growing probability you're going to rip right back to the mean. You get rejected, another 2 ATR to the downside, and once again, a growing probability. You're going to rip back up towards the 21 and then roll right back over. So we could just leak out from here, or you kind of get your you get your teeth kicked in trying to go short the extension. So what I am looking out here for early in the week, yes, we could roll over. Do we see a rip back towards the 21 period moving average? That can be a nice move to play back to the upside, but if we ain't closing back above the 21, lock up those gains and then get ready for another rejection, and potentially you see things roll over and we make another low. So it's just the basic concept of reversion to the mean. We're looking we're looking for opportunities here within the volatile market based on that same concept. We want to try to short the market as it pushes away from the 21, lock up those short gains. Then you can play the market long back to the 21, lock up those long gains, short it back down for another 2 to 3 ATR move, rinse and repeat, rinse and repeat. Ultimately, the day's going to come where we're closing back above the 21. We got exhaustion, we got bullish momentum. Now we're still following the same concept and respecting the same guidelines, just in the opposite direction. Once that day comes, we're getting long at the 21, and we're taking profits as we move 2 or so ATRs to the upside. Waiting for the dip, getting long again, rinse and repeat. So the market is basically giving us the same game right now, just to the downside. And with the volatility, it's a lot quicker and a lot, call it, more vicious, so to say, than you typically see on the upside. But it's the same game. So regardless of the volatility, for those of you who are in the simpler options room, at least for trades that I alerted, this is actually one of our better weeks of the year so far. So, really honing in on this concept here of picking our shots wisely, both long and short, based on that concept of reversion to the mean. For open and close trades this week, it was a solid week. Last weekend, heading into Friday's close, we're extended. Tech is drifting 2+ ATRs to the downside. So we already know heading into Monday, everyone's leaning short. There's a pretty good probability you're going to get a rip back to the 21. So we saw the put credit spread on Google, and then early in the week, as the market ripped back to the mean, Google makes a nice push, and we buy the spread back for 50% of its max profit. As we get rejected, we sold a couple call credit spreads on Amazon. We sold a couple call credit spreads on the Qs and on NDX, profited nicely on the flush down. So, this kind of leads into the bigger discussion of the video. And what I'm not going to do is talk about, necessarily, here's what we traded this week. Here was the P&L. Join the Simpler Options room, because I do know for a lot of folks and a lot of new traders, a week like this can be pretty ugly. So here's a snapshot of the trades we took this week in the room. Blah, blah, blah. Pretty irrelevant. What I want to discuss here, guys, is just based on the emails, the Twitter alerts, all this stuff. I think a lot of you are trading too big. Right? And proper position sizing is one of the most important things that you need to really take into consideration as a trader. Reason being is that in certain environments, it's not difficult to make money. And I'm a big believer that when the market is just, reversion to the mean, pullback, you get long, just kind of rinse and repeat. Anybody can make money during those kinds of periods. It's when the market begins to break down a little bit, that's when a lot of traders who are significantly growing their account, and they're loving life and they're just killing it during the momentum, they're giving all those profits back. And a huge reason is improper position sizing. You keep loading the boat on calls on the dip, and it works, 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 and then ultimately one time it doesn't work. And if you keep over leveraging and you just keep forcing the issue and keep on putting on risk on the table, once things unwind, and at some point in time, regardless of how strong the market is, things are going to unwind, that can wipe away all of your progress. And I think the big thing when it comes to position sizing is, actual acceptance of the risk. If you put on a put credit spread on Amazon and your max loss is $2,000, you need to be 100% comfortable with losing that potential $2,000. Trading with too big of size works great when the market is working in your favor. Trading with too big of size once things go against you, it's a recipe for disaster. So, with the market pulling back this week, you got kind of two camps of traders. You've got, to the left here, the traders who trade too big. They're playing with too much size. They're risking, far too much of their account on a given trade. This week was probably emotional hell. They're taking significant damage. They're wiping away all kinds of progress from February, from January. Then you got the group of the traders to the right here who focus on probability but also focus on proper position sizing, accepting the full risk they're putting on the table, and then being accepting of the fact that it's just a probabilities game. Now, the best trader in the world might have a, say, 70% win rate. For conversation's sake, best trader in the world has a 70% win rate. Caked into that win rate, caked into the realities of that probability, out of every 100 trades, that trader is liable to lose 30 to 40 trades. It's just what the probabilities tell us is possible. Losing trades are a part of the game. What we can't choose is the order of those outcomes. What we can control is focusing on good, clean setups where at that present time of entry, there's a probability of that stock moving in our favor. We can control how much risk do we allocate to that trade, but from that moment forward, it's just a numbers game. It's just a probabilities game. When you're trading too big, God forbid you take 1 or 2 or 3 losses in a row. That's just how the probabilities can play out because we can't control the order. If you're trading too big, you can get destroyed. So, just judging by some of the questions I'm getting and all the messages, it's something I think for a lot of you to consider. My put credit spreads on Amazon are in the hole right now. However, because I'm accepting of the risk and I'm comfortable with the risk on the table, during the last couple of weeks, I'm not caught up in my feels. I'm not hanging my head low. I'm not, emotionally distressed. I'm taking advantage of the flush in the market. So, now, for those of y'all in the Simpler room, we're taking some good trades this week. Yeah, I'm taking a hit on Amazon put credit spreads, but I made $8,000 this week trading the market to the downside. And this is all, relative to account size, and P&L is kind of meaningless for the purpose of these videos, but those are the two camps of traders you can find yourself in. Those who are trading too big and are just kind of getting devastated, so to say, when the market unwinds, And those who are using proper position sizing, they understand it's a probabilities game. Instead of kind of sitting here with your head in the sand, it's kind of like, whoa, the market's pretty soft here. Let's take advantage of this. So, from Amazon's perspective, I'm in good shape here. And I'm going to save the Amazon review for a totally separate video because there's a long list of things we can discuss here. But I haven't been sitting here over the last 2 weeks, kind of licking my wounds and getting caught up in my feels. I've got March monthly expiration, April expiration put credit spreads. I know the max potential loss I can take. So let me go to action here. I've got X amount of a max potential loss to try to cover over the next 2 to 4 to 6, whatever it is, weeks. Let me take some action. If the market wants to play here, you want to dance, baby, let's dance. Two totally different mindsets. So over the last handful of weeks here, we're continuing to look for these opportunities to sell call credit spreads on Amazon in the simpler options room. And I got to tally things up here. But essentially, I've covered a really big portion of the max potential loss on those put credit spreads by not being caught up in my emotions, by not getting caught with my pants down, trading too big with things coming against me. But we're taking action and we're taking advantage of what the market has to offer here, and we're covering that bottom line risk. So interestingly, and let's be objective here, this isn't working, but we're taking action. So interestingly here, and again, we're going to save the Amazon review once these trades are all said and done for a good lengthy video. Come March expiration, come April expiration, if Amazon turns the corner here, then this whole endeavor will be one of the biggest home runs of the year. We already locked some pretty chunky gains on that first nice push. We then scaled back into more sets of put credit spreads. We're killing it in the weakness here, selling call credit spreads, covering all that potential loss. And now should we get a bit of a bounce here and some relief, if we can just get out of the put credit spreads at break even, or if we can even close some of those put credit spreads for profit, then this whole endeavor here has been a home run. We booked the gains on the first put credit spread. We're slicing and dicing, bringing home some great weekly gains on the call credit spreads, and then we might be able to cash out on the put credit spreads. Or Amazon completely rolls over here, and we did our job of keeping our head above water, covering our risk, and it's just kind of a small break-even scratch of an endeavor. We shall see.